Welcome everyone. I'm Brett Johnson. I am with the Northwestern University Transportation Center, and we are pleased to welcome you to our last Sandhouse Rail Group presentation of 2021. And I just want to let everyone know before I hand it over to Norm that after Tony's presentation, we will take questions, and you can send questions in through the Q&A function at the bottom of your Zoom screen. So we will be monitoring those during the program. So please send your questions there. Norm, the floor is yours.
Well, first of all, let me thank everyone for joining us and give you holiday greetings, because that's exactly what we would do if we were at Maggiano's. And as you saw, Brett had Maggiano's logo behind him. Hopefully next year we can do this live in person and have Tony in Chicago and be live not only in New York City, but in Chicago. This is a tradition to have Tony speak with us. Tony tells us that he really values speaking to our group and being invited by Northwestern University, and we feel the same way. We're very happy to have you, Tony. So you certainly do not need an introduction with our folks, and with that, please tell us what you think.
So thank you, Norm, and thank you, Brett. And I just want to tell you guys, I'm going to have my last bite here to show you that I'm thinking of you. I'm having my pasta here. And I wish you all Merry Christmas and Happy Holidays. And I'm ready to start. But I wish we were in person. I'm hopeful that if you think about where we were a year ago, we're still uncertain, but things have certainly improved to a great degree. So hopefully with that level of progress over the next year in understanding vaccination stuff, we can be in person. I really do treasure that. So I'm going to just turn my my face off so that you don't get distracted by that horror show. But I'm going to continue to talk here about what we're seeing here. You talk about CP+KSU, which is really what I should call it. The TCI issue, which is the existential fight for the battle of the soul of the rail business, about the STB. A lot of letters here. As you know, we always like alliterators in this group. Okay, I'm having some trouble on the page down already, Brett. It worked before, but I don't know why it's not working now.
Tony, click on your screen again.
All right, I'm going to go back to this. Let's make. There it goes. Thank you, Brett.
You're welcome.
All right, top 10. I'm not going to read all these things here. We're not quite done yet. The Delta Blues. Yeah, we got over the Delta Blues, and now we're in the Omicron confusion. The latest thinking maybe is that while it is perhaps more contagious, it's less painful. This is a long process. I won't go through all these, except that really what I think here is that this pandemic was not like a rock in a pond, but the ripples. This really was a boulder in a puddle, and its impact on the supply chain, on railroads, on all of our lives continues in ways sometimes we forget that traces back to, that all the way back to March of 2020. The shark's tooth that I mentioned here was the railroad's complete shutdown, with the economy shut down, with production shut down. March 12th here in New York, we went into shelter in place, and the railroads also, shut everything down, and then had to manage a rapid, ascent as things were, volumes were coming back faster than anticipated. I mean, if you remember March and April last year, we had no idea what was going to happen, and I think railroads got a very good grade for their performance from May on in 2020 in terms of handling both the shutdown and the reestablishment. That grade is not quite as good this year. We'll talk about that. I mentioned that most of these are recurring and accelerating rail trends. That, for example, the mix shift towards higher levels of service had been going on. The faster decline of coal in 2020, that has not been true in 2021. And I'll talk about that in a little bit. But these things, the success of PSR, and we will talk about that, the success where it is successful and the issues where it's not. But the fact that we still have a fight within the railroads over the cult of the operating ratio, the fight over how to best spend free cash flow, as Chairman Oberman talks about, buybacks versus CapEx or a balanced plan. And going all the way down, you can see in this, the railroads all produced very good financial results throughout this pandemic. Financial results, not always operating ones, although they are not unrelated and they're not unimportant. You need to have good financial results in order eventually to continue to produce operating and service ones. The lore of M&A and Shortlines, we just had another deal announced last week. Throughout the pandemic, the interest in infrastructure and private equity funds, which are related but different, and by other shortline holding companies to purchase shortline assets, never dimmed, even in the darkest days. And the hype on value trap on rail consolidation, here I'm referring to, big four final round consolidation. I'm not talking about CP+KSU. I always use something, I used this very slide last year. I'm going to use it next year, but I just think it's important to say that railroads have 5, and you can argue, and I really should make this 6 advantages. But the first 3 are under attack, whether it's, on purpose or not. That is, they have a huge labor advantage. If you just imagine a double stack train versus the number of truck drivers, right? The fuel advantage, the AAR uses 4-to-1. I'm not so sure that 4-to-1 advantage in terms of steel on steel transportation versus diesel highway is still 100% accurate. Given that there are trucks have made technological improvements, I'll get to that in a second. But they have even higher carbon emissions advantage, and railroads are touting that heavily now, and they should. But all those advantages there are tactical, and I mean that because they are, being eroded at present by technology, from Elon Musk to Google, Alphabet to Ford. We're looking at EV transportation. We had 2 IPOs of autonomous vehicle companies that value these companies at multiple billions of dollars. Too Simple, Rivian, others are out there. And of course, electric vehicles are eroding that advantage, and therefore also eroding the carbon advantage railroads have. I don't think that can ever eliminate all these advantages, but these were huge selling points that railroads almost didn't have to do very much. Now they find that they need to work very hard to maintain advantages and grow them. And I'll talk about that later. The other 3 advantages I list here are ones that I think are harder to erode and therefore must be protected. Warren Buffett often talks about building companies with moats. And there's no bigger moat than the infrastructure advantage. Even as we have this infrastructure law now passed, you could see that was once a huge disadvantage for railroads of maintaining their own infrastructure and having to pay for it versus a subsidized waterway and a subsidized highway system has shifted to an advantage because they can pay for it when they see opportunity and good potential return on investment. Whereas highways, bridges, ports, waterways, locks, dams, all have to be politically paid for, if you will. And so we've seen the difficulties there. And I will mention that in 2021, the American Society of Civil Engineers put out their grades. They put them out every 3 or 4 years. Highways got a D, railways got a B, and that would have been a higher grade if you simply counted freight alone. Freight railroads alone would have been a B+. The condition of, say, Amtrak's rolling stock took the grade down, half grade down. So that infrastructure advantage must be maintained. The railroads have, clear lines across the country now with positive train control, et cetera, and they've got to maintain that. They can maintain that because they're in excellent financial condition. They can afford their CapEx. They can afford to maintain them. They can also afford to invest in technology to try to defend those numbers 1, 2, and 2.5 with emissions, and they must spend that money in order to add capacity, to add technology, et cetera. The 5th is their ability to reduce expenses in a known slowdown. If you looked at the performance in the first half of 2020, in the biggest known slowdown of all time, you can see what I'm talking about. Now, I won't spend a lot of time on the new administration. We will talk about the STB, even more relevant than before, although I don't believe the STB is a partisan body. I think that the opinions of the former chairman and Begeman are not radically dissimilar to the opinions of the current chairman, your fellow Chicagoan, Marty Oberman. But I think this STB is more effective. And with all respect to my person I would call my friend, Marty Overman, I think that's a little bit worrisome. Infrastructure, we know what's happening there. The railroads actually got a pretty good result in the infrastructure bill, helping with things like grade crossings and not overly subsidizing the competition. What the railroads want in terms of technological advancement and things like AV and EV trucking is is modal parity, not to support one mode over another. I remain concerned about crew size. I remain concerned a little bit about the FRA, which has removed some, I will call them, this is not the correct term, experimental exemptions on automatic inspection of cars and track that we see working well in Canada that have been tried here, that have been removed because they're viewed as a labor reduction advice as opposed to being actually just more accurate, et cetera. Trade, we're finally seeing some unwinding of the trade policies of the previous administration. Remember that the railroads are heavily weighted towards trade. We are a border blind industry from certainly the shipper point of view, and from my stakeholder group, the investor point of view. Canada, you can buy Canadian Pacific and sell Union Pacific stock, or vice versa, or own both. You could ship from many railroads to get into Chicago. You could go Canadian via BC ports to get goods into your hometown. So we don't look at it that way. So these trade barriers are put up in the 2-year fight that I think destroyed a lot of foreign direct investment into Mexico to create the USMCA, which from a rail perspective is exactly what NAFTA was. So I think we're beyond that, although we certainly have not removed the tariffs on China, et cetera. Not that seems to have slowed down imported TEUs at all. A little bit about the short lines here. I won't spend a lot of time, except the STB, which has a full plate, right, has still got an issue with the Messina line. There's a lawsuit involved. I don't know where we are on that. Perhaps if somebody at the STB is on, we can talk about that later. We have the Amtrak. They're going to be hearings next year, early next year, I think during Mars, and I will be at Midwest Association of Rail Shippers. I hope to see you there January 13, 14 in Lombard. But we also have an incomplete Pan Am opportunity here where CSX is buying it and they're creating a new Pan Am Southern with Norfolk Southern and Genesee and Wyoming, and that's got some opposition. Wisconsin Central and Watco, that deal to me is the biggest slam dunk of all time for their shippers, is running has run into delays, and of course Kansas City Southern, which I'll just to quickly summarize, will happen but won't happen, I think, quickly. I also want to emphasize that infrastructure firms, when they buy, have super cheap money and super long outlooks, and are really in many ways from a long-term investment perspective the ideal owner. Macquarie just purchased Rail USA assets, which include that the Florida Gulf and Atlantic, and in Mississippi the Grenada line. So you have another major infrastructure firm. They are, when people say look at that they're paying 14, 15, or 16 times, that these are ridiculous multiples. Keep in mind how cheap their money is, and that these are really lifetime purchases. This is the complete opposite of short-term investing, which is not the majority of Wall Street investment, but certainly is a vocal minority. It's something that needs to be resisted when you're looking at railroad investment. Railroads in the fall of 2020. So let's talk about this. I guess we could almost say we're winter, but not quite. Railroads had tried to move from the cult of the operating ratio, which is my phrase, to really focusing on growth, technology, and ESG. I think that was really the theme that railroads wanted to talk about in January of 2020. And then, of course, reality hit them hard, hit all of us hard. I think, as I just learned from my Rail Trends conference a couple of weeks ago in New York, railroads are trying to reinstall those themes. And you could argue, well, they talk growth, but what are they, are they they're talking the talk, are they walking the walk? And I just want to say that if you begin to talk this talk, you will be held accountable to that by my stakeholder group. In other words, if your goal to say is my value should be based on my ability to grow faster than the economy, to grow volume, to grow rates, to should be a growth company from a cyclical perspective, then that's the questions you're going to get from your investors and from analysts. That's how you will be held up as to whether you're successful or not. And so you need to walk the walk. but you have to start by talking the talk. And I think successfully and countering maybe what some critics have said, they really want to focus us on this. And so all of the railroads at Rail Trends use an opportunity to talk about those three items. ESG is not only the environmental side, but also social and governance. I will tell you that almost half of the the professional investor class of assets held are under some form of ESG mandate. This has gone from being, what I would call a rich person's problem. Yeah, we feel bad about the environment. Let's go plant some trees because I have a lot of money, to being a fundamental everyday piece of business. And I think it's truly happened. When I write comparisons there, it's very hard. We know what's happening with dwell and velocity, and we can talk about supply chain in a second. But really understanding how well the railroads are doing, we need a base year. Again, I thought 2020 was going to be a base year, and obviously it was anything but. I told you I would give rails a B+ for their performance in the recovery last year. I would give them a C this year. Rail service is an issue again. The American Chemistry Council has been very vocal. As Churchill said, never let a good crisis go unused. The House TCI committee has been very vocal. We know the STB has been very vocal. I will say that the chairman of the House TCI committee, which is probably the most important political person on the railroad side, is retiring at the end of his term. And Congressman DeFazio was a very good congressman, but I bet you the railroads are breathing a sigh of relief there. Earnings have been pretty good. The only two earnings that were slightly below expectations actually came from the two companies that are merging, so nobody cares. Supply chain fragility is a perception problem as well as a reality problem. First of all, we are certainly going to have Christmas. I sort of suspect that part of what's happened here is the retailers' desire to smooth out their once very sharp cyclical peak and say, hey, you better buy now because you may not get it. And the expectation among many who follow the retail business is people will simply buy more. They bought in September for fear of missing out on the hot toy, and they're going to buy again now in December or on Black Friday. But certainly, there were just a couple issues. This is labor-based. It starts in the manufacturing and transportation supply chain and ports in China. It goes through the shipping business. It goes to the ports, warehouses, drayage, chassis managers, and railroads and trucking, general trucking here. It is an enormous issue. It is front page news every day with all sorts of really odd things. Right now in New York, we face, and I kid you not, now that we've just left Hanukkah, a shortage of cream cheese because of supply chain issues. I wanted two things to say. I think nearshoring is more myth than reality, and I'm happy to talk about that. Although nearshoring into Mexico, if they had a more stable government, might be accelerated. Mexico will be a growth market. The joke there is it's the economy of the future and always will be. But I also don't think the idea that these trade policies and other things have made a huge move to manufacture back in the U.S. Is probably greatly overstated. Also, the move, we just announced a Toyota battery factory in North Carolina. The move to create more EV, electric vehicle production in the U.S. is going to be severely challenged by our two allies, neighbors, and USMCA partners. So the buy U.S. is definitely going to, I'm not sure that's a successful strategy. From a rail perspective, it doesn't really matter, but trade is critically important. Also, if we move from just in time to what they're calling just in case, if we, both as a railroad system and as a global supply chain complex, move towards more resiliency, adding a little time, that is very positive for railroads indeed. So we then added consolidation into the mix, which gives the STB an opportunity. And we added the White House to the mix of this story too. And I'll cover that. The executive order was a big deal when it came out in the late summer. It really isn't a big deal. The Wall Street Journal broke the story as if it was focused on railroads. There are 72 industries, of which by far technology, big tech, and even meat packing are much more on the White House agenda than railroads, but people were able to get the railroads into this. I think it's simply, it's consistent with existing STB viewpoints, which are that railroads are monopolistic, although the executive order suggested duopoly. They're overly focused on cost and headcount reduction when service is going poorly. Those are two facts that are, in my opinion, uncorrelated. They are in bed with Wall Street, which reminds me that all industries, every management of a public company is trying to enhance shareholder value, and to what degree that's consistent with stakeholder value and some of these other trends. That is what Wall Street absolutely is in bed with Dow Chemical, Ford Motor, Tesla, et cetera, et cetera. They do not take one industry above others. The enthrall with PSR is, I think, an outdated version that's PSR 1.0. Norm and I can argue about this later. But I think these viewpoints were already held. The issue of what can the STB do is mostly hearings. They are in charge of, 3 commodities essentially, and only that business within those commodities, chemicals, grain, coal, and correct me if I'm wrong on this, on only those commodities that are not under contract, which is a very small amount, only within the United States. Remember, this is a continental industry. And coal, of course, is, despite this incredibly positive year this year, going away or being reduced every day. So the STB is looking to do things about rule changing, such as their March 15, 16 hearings on reciprocal switching, which I'm happy to talk about. The STB can look to expand its footprint into other commodities. They're looking at, first and last mile statistics, which are another way of using what they really could do is shine a light on things. And that's not unpowerful in of itself. The House has the power to potentially mandate 2-man crews, which would be disastrous and also are proven to be not a safety issue, all relating back to that accident, that horrible accident in Quebec roughly a decade ago that involved a 1-man crew, but that crew wasn't even on the locomotive. The locomotive was parked. It had nothing to do with this issue. But in the time in which labor has more power, we're in labor negotiations right now, and we don't know really what's happening. There are job shortages. This is an ideal time to be negotiating contracts and pressing their point. And I truly hope that we are in a situation that we do not see mandated 2-man crews, which would negate technological advances by the railroads and absolutely put their finger on the scale between rails and trucks. So I expect more hearings. I expect to be in DC in March, and we could talk about that further. The STB turned down, of course, the voting trust for CN. That deal is over. I also believe, in retrospect, CN never had a chance with the 2 separate rules under the new rules of trying to enhance competition. I also believe that's game over for future rail consolidation, and I agree with Chairman Oberman about that. We see what's happened there. There was severe succession issues in this industry. We could talk about Norfolk Southern if you'd like. There are still 3 major railroads without a known successor, and that is a destabilizing influence. Those are Union Pacific, CSX, and of course CN. Now we have an issue where Children's Investment Fund has got a proxy fight against CN. They weighed in during the takeover. They own 5. They're the largest shareholder of CN, or second. They own 5% of CN as of last I heard, and 8% of CP. So shades of Jay Gould and Wall Street manipulation of railroads in the 19th century. This fund is definitely playing. Its job is to play for its shareholders, not necessarily the shareholders of others. They're going to bring in Jim Venna, who was a well-respected operator, to replace J.J. Rouet, who was a Railroad Innovator of the Year and who is retiring at the end of January. And they are, if not directly saying, they are allowing to be said for them that that CN must remove its focus from growth and back to margin to close its operating ratio gap to CP, especially, and to its peers. In response, CN announced the job reductions that was very painful, an operating ratio goal for 2022. The vote is in March. Chairman Oberman very rightly at Rail Trend said this reaction is exactly what he doesn't want to see in railroads. Keep in mind, only 1/3 of CN is under any STB purview, but the point is the reaction of job cutting, capex reduction, share buybacks, and operating ratio focus, it ticks every negative box to the regulators. It's truly not misreading the room. If the world had heard J.J. Rouet's speech about defending growth and defending the new railroad and what the new railroad should look like that he gave at Rail Trends, we would not be in this situation. In my opinion, it's not that Jim Vena per se is bad, but the idea of turning from a marketing-based CEO to an operations OR-based CEO is literally fighting history, in my opinion. Note that when Norfolk Southern finally announced their succession plan, which may have come sooner than expected for some, they turned from their current CEO to a CMO, Chief Marketing Officer, which is what I believe the railroads in the future need to have. Good operations. They need to be consistent. These are critical things. But if you're looking to the future, a tech-savvy, marketing-savvy CEO is, I think, critical. I'll talk a little bit about technology here. And I'm not going to go down this in the interest of time. I'm very excited about new loco power exemptions. You've got Wabtec, you have a Caterpillar, the EMD looking at various battery and hybrid, CP making their own locomotive with hydrogen power. I mean, this is really critical if you remember the gaps with EV trucking and the emissions and the ESG game. Rail Pulse is, I think, a real game changer for the industry. It's a way of getting, it really is a diplomatic achievement to get car owners, which are mostly financial concerns, shippers, class ones and short lines together to look at a visibility platform that may have short-term pain for car owners, but long-term gain for railroads to make the pie bigger. This is an effort to get more rail business than truck business, rather than to make just the class one who's first sponsored this, Norfolk Southern. It's really a diplomatic game to move beyond. The inspection portals at 1 and 2 are the things I talked about. FRA pushback despite their proven success up north. So this is a huge area that requires a lot of my continued study, because as you saw when I just tried this presentation, I am not a tech genius. Go quickly through traffic. You know all this, but I just thought for your own sake to have this would be useful. You could see what's happened. Recent traffic has turned down. The real comparison is 2019, 2020 being such an odd year, right? And you take a look at the comeback, the big drop in the comeback carloads, chemical shipments, remain a bright spot. This was expected by me and others to be a boom. It's been consistently good, if short of a boom, due to this is another follow-on impact from shale. This is revenues from coal. So 21, you're going to see a jump up here. You can see in the coal share, the total of revenue from coal. One of the things also to think about is export coal within the coal mix is incredibly profitable. So some of those units you had decline in numbers of coal and some pretty decent revenue years in 18, 19. You still had strong export coal. That number is inconsistent, but is probably under less, it's under political pressure, but less so than the cost pressure that is going on in the United States. This is not a regulatory response as much as it is a natural gas availability response. Total carloads, if you can see, here 21 above 20, still below 2019, but that was not fully expected. The EIA expects coal production to be up this year about 20%, but to be down next year about 5%, and still be below 2019. So here's another way of looking at electricity from coal and tonnage. These are, it's still the domestic utility business is the driver, and it's driving south. Grain carloads have in the 2020 grain carloads were a great story, and because in a year, in a commodity that's so incredibly unpredictable because weather, politics, the dollar, etc., you had it in both sides of the U.S.-Canadian border, good crops and good movement, good exports. And it's a really tough year. That was one of the consistent shining spots for railroads. That is turning in 2021, above 2019, but you're seeing, a tougher situation. Exports are slowing down. Wheat crop looks to be bad. It's going to be probably a tough first half as well. Intermodal growth is the main story. We used to be able to look at trailers and containers and use that as a proxy for international and domestic. It is not anymore with transloading, but you can see one of the things I always like to point out is that 2019 was a tough year. The first year in which the economy grew and rail intermodal did not grow faster, much less shrink as it did. This was a period where the railroads had a true economic fumble at the goal line. It wasn't in the fourth quarter. They can recover, as my friend Larry Gross points out, but they've been losing share since 2018 when there was severe truck shortage. When there was a truck surplus in 2019, most of that business they picked up in 2018 was trailer business. If you look at that down at the bottom and look at the drop, if you can sort of spot that, it went right back to the highway. That was a huge opportunity miss. Looking at intermodal over time, it had a pretty good first half. It's starting to slow. Some of this is supply chain, issues. As we know, you see all the ships looking. I went to Intermodal Expo in Long Beach, and we looked out at the harbor. It looked like the black and white photos I'd seen of Normandy after D-Day. Truly remarkable. And this is not the railroad's fault per se. They have a role in it. If you talk to big international shippers, their concerns are entirely port and steamship line, both in price and performance. And I would tell you that there's a labor negotiations will begin in January on the West Coast docks, and I'm nervous about that. Not just about the possibility of a strike, but the possibility of doing short-term gain for labor, the long-term hurt for LA Long Beach. If LA Long Beach does well, railroads do well. Do not buy the hype that they want, that Eastern railroads want to see growth in Charleston, where most of that business goes off on the highway versus picking it up in Chicago from a Western carrier. Look at intermodal year over year. You look at 2018 and 19, that was the fundamental issue. 20 is all about, you also have, by the way, distorting this starting in 17 is the trade war. So you had pre-buying and then tariffs and whatnot. It's really hard to get a handle on what's truly happening. But our expectations are that railroads are underperforming their opportunity here, and that is not. That must be turned around for their long-term health. This is job openings. Look at the jump up in warehouse, transportation, warehouse, utilities. It's been really unclear. Studies have shown that it wasn't subsidies. I mean, after all, if you could see that the job openings continue after the unemployment benefits stopped, it's not clear exactly what's happening out there, but it is universal. So you have shippers who don't have the ability to have people handle incoming freight, warehouses who can't hold it, drayage driver. The whole system is a problem. I'm going to just sum it up with some themes. Kansas City Southern and CP is going to be approved. I think I learned clearly from I'll quote the vice chairman of the STB, Mr. Primus, who gave quite an eloquent speech virtually at the Northeast Association of Rail Shippers meeting back in September, October, in which he said, this is the first merger of class ones that we've looked at in 20 years, and it's probably the last merger we'll ever look at. We're going to take our time. To me, the most important issue is what I call the existential fight between CNI and TCI. There's also another maybe unrelated activist fund involved in Canadian National, and that's Elliott Management. As of now, that's 11/21, 12/21. That's going to dominate the headlines. Although we haven't heard very much from TCI of late. What's going to happen? I'm happy to talk about it, but it's important symbolically. It's also important. Canadian National is the mothership, not just for precision scheduled railroading, from the difficult implementation, but then to quite a successful railroad operation, whose a protege whose children have gone out in the CN diaspora to effect change at Kansas City Southern, CP, CSX, Union Pacific, Norfolk Southern. They've also been the best growing railroad over the last decade. They've been surpassed in the second half of it by CP, but they've been a truly good story, and the fact that they need to be attacked as opposed to railroads that are truly understanding poorly is very confusing to me. My RailTrends conference happened. Christmas will happen in December. Railroads must improve their metrics. One of the themes out of RailTrends, and I sent my review of it to Brett, and it's welcome. Any of you are welcome to have it. He could, if you ask me or him. it was that railroads are making that talk. They understand where they are on this. I expect significant hearings next year. First, Ian Jeffries of the AAR and then Chairman Oberman both said they have a new hearing room, and it's about time that they put it to use. And so I hope to get to some of them. Otherwise, I'll be watching on my laptop as you all are now. So it'll be interesting to see how the street influence. 5 of the 7 U.S. railroads earned their cost of capital in 2020. The SUE numbers are late. Frankly, the cost of capital is high. I think all of them earned it. The critical element here is not operating ratio, but ROI, return on investment. All those other STB's got a lot of stuff going on. They're now looking at train length. I think some of these things, Mr. Oberman and I would strongly disagree about what I would call overreach. Looking at business strategies of private companies is not, in my opinion, government business. And in saying this, Mr. Oberman and I share the same political party. So I'm not trying to wave a University of Chicago flag here. I don't have one. If anything, my flag would be purple. Thank you very much, Brett. Succession issues must be resolved. This is what I was going to talk about. It. One of them was resolved. This is really critical to understanding the direction railroads are going to take. It also removes issues that could involve disruptions like activists. Growth, technology, and ESG are the themes, and they have to be. They are talking the talk. We will have to judge whether they're going to walk the walk. And is this the last stand for coal? I just have a couple more to show operating ratio improvements. I want you to have that for your own sake. Here's operating ratio over time. But this is really, I said, return on invested capital. And if you look at the improvements in the third quarter, looking over 12 months, and if you look at the total numbers, this is, an answer. Railroads are investing and they're getting paid to invest their money in themselves. Here is that STB number where the numbers have turned positive, the spread between the weighted average cost of capital and the return on invested capital. This is US only, but it gives you a sense that railroads, have finally earned the right to spend all that money. They're spending 18 to 20% of their revenues here. If you take a look at these numbers, they're quite large. Have they come down off the peak? Yeah, but they've stopped buying locomotives to the same degree. They've upgraded their fleet. They're doing more rebuilds, et cetera. Although you saw UP in the Climate Action Plan announce a locomotive purchase plan, but you're seeing these numbers come down. 21 will be up, and 22 will be up again. These are healthy numbers, and really, as you see, the driver in the decline was in equipment. Here's infrastructure and equipment. If you see the infrastructure numbers did peak at 15, but they, significantly over a 5-year period. That's big numbers. It's clearly tied to return on investment, right? If you get a good return on that investment, you will put money into it. If you anticipate that you can't, you won't. And these are the things that regulation could stop. I point you to the Canadian prairies, where terrible regulation meant it made no sense for either Canadian railroad to invest in new equipment because they weren't going to be able to reap any benefit for themselves for it. Once those rules were relaxed, you saw billions of dollars go into new car production, a new rail car, grain car acquisitions, and they still had 263 cars out there. For those of you who know what I'm talking about, now they have a 286 fleet. I'm talking about 3 years ago they were running a fleet that you would never see in the United States, and that's just a sign of what regulation can do to capital investment. Correlation with income, this is a slide from Oliver Wyman from my conference that said railroads have the opportunity to grow $61 billion additional dollars if they basically get their act together and from a technology and customer-centric opportunity. That's the world that the new talk is talking. That's where we have to check the walk. I was the North American Association of Rail Shippers Person of the Year in 2019. It remains my proudest moment in the business. And there wasn't one in 2020. Bruce Mann was given the award, but since we had no meeting, I'm the only 2-year holder of it. So I'm proud to put that out there, and that's going to stay on my slide deck. Here's how to reach me. I'm going to put my ugly mug back up here and happy to answer any questions you might have.
Hey, thank you, Tony. Turn my light back on. Let me run through a few questions with you, and I'm sure more will come in while we're sitting here. I asked for one clarification on one because there's too many things going through my head. So to kick it off, Tony, Scott Sigmund asks and says, There is an upswell of calls for new 2021 Shipping Reform Act that may change dynamics of the BCO and ocean carrier relationships, often where railroads are in between. How do you see any legislative adjustment influencing railroads, or what side would the railroads come down on if the Ocean Reform Act advances?
So I don't know the answer. You're right that they're often in between. They pick it up at the dock or at the warehouse if they're restuffing the containers. You know, there's a whole issue of containers staying in the dock, not moving inland because they want to rush them back to be refilled at those great rates heading, to California at $3,000, that huge increase in price. So that means there aren't boxes to move back for backhaul, and it's affecting the ag business, et cetera. The railroads are reactive in that. I don't want to, you may need to talk to Ian Jeffries to get an AAR rail perspective or to the individual railroads. And Scott, let me know. We could talk offline about this because it's interesting to me, but I don't know the answer. I don't think they have a strong opinion. Again, you all know where I said politically where I vote, but the idea that the government's going to solve the supply chain problem is difficult for me to gather because what they often forget are the unintended consequences. For example, supporting a mode through technology leads to modal share gain by that mode, which could actually be hurtful to the greater carbon emissions gain if you're talking about rails versus trucks. The government, it's very hard for government to look through an entire issue in order to get it politically palatable and do it quickly enough to solve this problem. This is we're in a tactical short term in the fullness of time. It's been multi-year and it won't be done till, through next year, probably. Supply chain crisis because of the greatest shutdown and regrowth of the economy that we have ever seen. The depression might have been bigger, but it lasted for a decade, right? So this is, a shutdown and reopening of an economy over the course of a year and a half. And we're reacting to these supply chain issues. Could we learn lessons out of this? Yes. Should we build resiliency into the system? Yes. Could that potentially mean more rail cost? Yes, it should. But I think the benefits will be enormous. If you have more time, and you remember just-in-time was created in many ways because of high interest expense. You didn't want to keep inventory. It costs so much. Interest rates may be heading upward, but they're from a very low base. In the fullness of time, interest rates are very low. So the idea is you can keep more inventory, you can have more buffer, and that's a pro-rail move. So I think that the market, I'm not saying markets correct all things, and you need to have regulations for safety and all sorts of things. But in this case, I worry when the government steps in to fix what is, although we're now been dealing with this for a year and a half, is a short-term problem, not a long-term problem. But Scott, I'd be happy to talk to you more. My guess is the railroads are just reactive to this, and it depends. I don't see how that changes. I bet you they're more concerned about the ILWU contract talks, which could potentially shift further share away from LA Long Beach, where although it's all congested now, railroads it's good for the rail intermodal ecosphere for business to come into California or the West Coast in general. And I include BC and Vancouver and et cetera, Prince Rupert. So.
Thanks, Tony. Thanks for the question, Scott. From Earl Wacker, what do you see as the impact on freight railroads of the STB pushing passenger rail performance and new routes?
So I refuse to answer any of Earl's questions next. I'm kidding. Hi, Earl. Having I mentioned my slide about the new administration, having a president who has a railroad name associated with his nickname, is in general a positive thing. There are frictions, as we all know, between passenger and freight. So, the devil comes down to the details. I don't know enough to really take sides on the issue between Amtrak, say, and the Gulf, but the feeling is that there is significantly more work that would need to be done to run Amtrak service through those freight lanes there. I have seen a very good presentation a decade ago by CSX, which has often had, I think it's the most Amtrak interaction, about what a single 90-mile-an-hour train does through a region in terms of capacity suck. So the idea of using infrastructure, you maybe using the rail right away to build separate lines. I'm not sure how this plays out from the general sense of government supported rail is a positive, and will play out in things like grade crossings and all sorts of ways. But specifically, there are certainly issues that freight rail feels about passenger. That's like, I would argue this is like an ambitious little brother that sort of gets in the way when Big Brother is trying to go out on a date. I don't want to take a side here. I'm a big consumer of Amtrak. I use them as here in the Northeast all the time. But the growth of Amtrak and freight rail must be balanced against the ROI things that these private companies with private capital use. It's I know they have the right to go over that, but the interests of the shareholders and really of the shippers on that line need to be protected as well. And beyond that, I really would need to know the specifics.
Tony from Mike US. Hi, Tony. Thanks for mentioning Wisconsin Central and Watco. Those of us here in Wisconsin are sitting on the edge of our seats, waiting for STB's approval. Any inside info on the delay, any predictions on when approval will be granted? Thank you and have a great day.
So I don't know why it hasn't happened already. Thanks for that. I mean, in my mind, if you are in a low density area and you are feeling underappreciated by a class one who are going through their cost structure issues, and now CN is preoccupied with this existential fight, and they were preoccupied with the merger, and they must, just because it's the law of big numbers, have a lot of sales effort on a global company. I'm picking Ford or somebody, GM. Right, and maybe not the kind of service that you're expecting, which makes economic sense for them, right? You got to handle your biggest customers, and you should handle everybody. But if you feel this, then having a short line, and I would say especially a short line like Watco come in, is got to be the best day you've had. It's Christmas come early, and so why this hasn't been approved, I don't know. I don't have any insight. One problem you face in Wisconsin, I'll say, is that the STB has got a lot on its plate. Now, I know it is scheduling hearings. For example, there's a Pan Am hearing, I believe, during the Mars meeting. So, they're doing business, right? They're not just looking at CP+KSU, but, the STB, is going to be busy. And so I hope they, to me, this is one of the issues that should have been behind them already. I don't know all the specifics. I don't know all the objections, but it would seem to me this is the solution that everybody is looking for. CN is looking for it to sell it. Watco's would be adding, something that they have, another operation to their lovely collection, and I think shippers would benefit, and that would make the STB happy because it would take shipper complaints away. Bang! It seems to be win-win-win. I don't know why it's not happening. I expect it will. I can't tell you when.
Hey, Tony, before I ask you the next question, I would just want to let everybody know that in the chat window, I shared Tony's presentation from today in PDF form. We will also post it online at our website by tomorrow. And within a week, we should have a video recording of his presentation posted as well. So look for that. Cindy Anderson asks, what are your thoughts regarding Amtrak's ability to successfully execute on its capital construction portfolio, given the large influx of IIJA funds?
I think very highly of Stephen Gardner and of Bill Flynn, who I knew back when he was at Sealand and then at CSX. So, I would, all infrastructure things seem to take longer and cost more. Government projects, we opened up the Second Avenue subway. I think it started, about 5 years ago here in New York City, not far from where I am right now. And I think that project started in the 20s. I don't expect that level of problem, but I'm not competent to specifically ask that. That's sort of an AREMA operating question. But, I think Amtrak is in general in good hands. So I would expect that they would, they'll benefit from this. But I hate to, I sort of deflected on all the questions so far, but I don't want to tell you something that I know what I know.
Here's another quick hitter from Kenneth Strawbridge. Why are the Class 1 railroads so bad at market development?
Well, I mean, they're not. They are at some, but look at the development of what was a sleepy lumber export port in northern British Columbia, and now to be, one of the probably the best container import port in North America. It's certainly fast growing in Prince Rupert. I mean, they look at Norfolk Southern's less than carload opportunity, or I mean, I could give you hundreds of success stories. I would agree with you that there should be thousands, but it needs a defined goal. The question in the past, rather than looking at the past, is let's ask me this question, not next Christmas, and maybe just ask me next Christmas, but 2 Christmases from now at Mangiano's, ask me the question. Let's see how they're done.
Yeah, I think that was a good, I appreciated your nuanced answer there, Tony. Marty Schlenker asks, you characterize RailPulse as a game changer. What drives your optimism?
Because it's an effort to, there's always been the issue in car visibility. And people ask me, why can't they be more like, the railroads be more like FedEx? And that's a legitimate question. I mean, there are some complexities. Their system is much more complicated because it could go from, terminal to short line to class 1 to short line to terminal on cars owned by GATX, for example, or somebody else. So you have all those stakeholders in there, each maximizing their own benefit, but not maximizing the rail benefit. At FedEx, you have just FedEx. There's no interlining. There's no, they don't hand off to UPS. And also at FedEx, empties are just envelopes stacked, 6 feet high in a FedEx store. So as opposed to, rail empties, where the empty inbound is probably as complicated or more so than the loaded outbound. What makes RailPulse, I think, potentially a game changer is that the stakeholders cut across the investors, the players cut across the stakeholder groups, from car owners and manufacturers to short lines to class 1s. I would like to see 100% participation. I think we'll get more announcements soon. I think one more class 1 and one more big car owner, and you've created the quorum they need. And that will get, one of the things that Adrian Bailey of Oliver Wyman spoke about, and that I quoted her in one slide in my deck, was customer centricity, and ease of doing business. Paper shippers complain about empty car management. They have huge bills in car management and leasing and whatnot that are there because of inefficiencies and lack of information. This information flow, and it's the technology is just the tool. It's the achievement and the effort to make the pie bigger, not arguing about the slice bigger, is really the game changer element to me. If it works, that's why I say the potential to be game changer. I believe it will, but that's the reason. I mean, it could just solve, and it's not easy to do this again. But the hard part is the diplomacy, the technology with PTC on there and GPS, and the technology has been developed. I'm not saying it was easy to do it. I don't want to say it's easy, but that's there. It's the will and the diplomatic and strategic will to do it that is being developed.
Thanks, Tony. I mean, I want to stick on the technology front here and ask another question from Scott Sigmund, which is, could one or multiple railroads lead or engage more in blockchain development, or take a routine standard, e.g. laggard role, and follow others in such tech developments?
Can you say that again? I'm sorry.
I think the question is about, could one or more railroads lead or engage more in blockchain development? I guess he's just asking you to expand more on the blockchain and other technology-related comments
I think Scott,
in the presentation.
Out here playing gotcha with me, so I'm going to have to defer that question again. Blockchain, is already used heavily by IBM, Maersk in their supply chain, and that's a critical rail customer. I mean, I think the answer is rails should participate more, but you're getting beyond my expertise. That, you know, you know, if we were at Mangiano's and go to the bar later, I could tell you that I think Bitcoin is a Ponzi scheme, but blockchain seems to have real use. And I believe, you know, all of the railroads, many of whom have hired new sophisticated chief information or chief technology officers, notably Union Pacific and Canadian National of late. So I think that you know, these people are sophisticated, and interesting, most of these jobs now report to the CEO rather than to either the COO or maybe the CFO. So that I think, you know, new leaders and more sophisticated forms, you know, understanding what's going on in other parts of the global supply chain will be coming into the railroad world. But that's a very basic question, and I'm sorry I have to give it to you that way.
I think that's okay, Tony. Bon French has a question for you.
Hi, Bon.
Why should there be such succession issues at several of the class ones? They have huge staffs and internal promotion programs. This is one of the core duties of a presiding CEO.
It's a very good question. There was a sense, and I don't know if it's true. There's a sense that railroads had the class of 2005 to 10, if you will, was a great class. You know, up and comers like Keith Creel, and that you had a sense that railroads had really deep benches. And there's a sense that that has been dissipated. I don't know if it's true. And one of the reasons that I'm also going to argue is the pandemic has taken 18 months of seeing each other. Zooms don't count. You know, being together at Mars, at Mangiano's, at NARS, at Intermodal Expo that did occur this past year. But, you know, these events, the railway interchange that was canceled, right? Where ARIMA and RSI and REMS, all those groups got together, and you would meet all sorts of operating people. You could see that was also an effective way of how you could communicate to other stakeholders, shippers, and to investors from the financial community who was the rising star, and you would move people around the way BNSF did. And they don't have to report to shareholders, right? They have one shareholder, but it was clear that Katie Farmer was, you know, was the person, and she was and is. You know, we lost a year of that or more. That's one issue. And the other is you have older CEOs and no clear person. CSX, I don't know if Mark Wallace, may he rest in peace, who just recently passed away, was, you know, going to be the next person, but that had to have an impact, just as BNSF lost somebody who might have been potentially a successor to Katie, although Katie's very young, and John Miller, and those are two sad blows for the industry. I think the biggest issue is, you know, is some combination of all those things. We don't know how deep the bench is. It's not clear. You know, also when you brought in some outsiders, which is usually good, that some may eliminate them as CEO if timing is tight. For example, the CFO at Norfolk Southern has only been there a reasonably short period of time, and therefore might not have, you know, all stakeholders might not have been happy with a non-railroader. So I don't. Your question is good, and it's a question I've been asking. That needs to be resolved. We need to know what's going to happen at CSX after Jim Foote, who, you know, looks like he's 35 but isn't, and the same thing at Union Pacific with Lance. You know, with both of them, these are two of the most dynamic speakers and industry leaders out there, but they are coming, you know, getting closer to mandatory ages, and it is not clear to me. You know, I can have my guesses at who might be the successor, but it's not as obvious as it used to be. When, whatever you think of his tenure, when Jim Squires was named the CEO at Norfolk Southern, we all knew he had been moved to various positions within the company to get exposure to the critical departments, finance, you know, operations and marketing. He had been a key speaker at various events. You know, this is, you know, when Rob Krebs from your local citizen, was promoting Matt Rose, we all knew. So when Matt Rose went, you know, the only question is how long did Rob Krebs want to stay in that position, and, you know, et cetera. When was the transition happening, and not who? It's a very big question, and it is a failure of the railroads. Although they have a slight incomplete grade because of the pandemic, slight.
Tony, this is, I have one more question that I'll ask before turning it over to Norm to close. But I'd also just want to let the group know I'd put another item in the group chat. And if you have an interest in making the Sandhouse Rail Group one of your charitable giving donations for the end of the year, please consider doing so. I put a link in chat. So thanks for considering that. This last question, unless our director, Hadi Mamasani, would like to ask one of you live, is from Chris Berger. And he says, it's hard to reconcile STB's apparent willingness to consider crew size regulation with the difficulty railroads are having to hire and retain people and its impact on service. Any thoughts on what will happen?
So I don't think the STB can do anything. And if anybody from the STB is on there and wants to disagree with me, that's great. But I don't think the STB can do anything about crew size. They are talking constantly about overall headcount reduction, but the crew size issues can be addressed negatively in two ways. One is through legislation that could come for the, say, reauthorization of the FAST Act, and it can come through in some ways through the FRA. And it will come as a safety measure, even though it's really been proven that we don't need that. In fact, railroads are going to fight autonomous trucks. Oliver Wyman did a study in 2017 under Rod Case, also known as Dr. Doom, that said, remember, trucking companies can change their fleets out in 3 to 5 years. And if you could get a digitized electric vehicle, autonomous vehicle, platoon truck, or a road train, in many ways, you could take 30%, you could attack 30% of the existing rail business, and that would be devastating. That isn't going to happen in railroads. I mean, so except doing this, but if you mandate, if you endorse AV experimentation development, you help actually subsidize it, and then mandate two-man crews, despite positive train control, a government enforced mandate, right? And the ability of things like Trip Optimizer to be able to, the technology exists essentially to run a railroad like a model railroad, like in Stephen Loeb's basement where he has the SP. You can, you could do this and do it safer. You can space trains more. The idea that of mandating this would be just a job protection act now at a time when there are, there's job shortages, but there's also increased labor power, and you have again labor negotiations right now. You certainly have the ability right now to go to one-man crews. And if any of you, like I have to do all the time, or I will when we go back to travel, fly through Atlanta, you're going on a driverless train. They're moving driverless trains of iron ore in the Pilbara right now in Australia. The technology exists. And frankly, if you think about comparing the technology to the highway, you have a single system, positive train control, on a private network with private police, right? That obviously we know people violate that private network. They trespass, they drive cars through crossings and whatnot, but they shouldn't, versus 100 different technologies with public policing on a public network on the highway. Which would you support first? And the answer is we seem to be, I don't want to stop safety development in any form, but I am, I think this is the question you raised is a big one. I actually will give the STB a pass because I don't think they're focused on headcount reduction in the service arena as opposed to the safety arena, and it's safety that will be the Trojan horse for two-man crew mandates or not. And that's what I got. But meanwhile, I hope to see you guys in Chicago in a year. Feel free to reach out to me. And Scott, you had some questions I couldn't answer. I'm happy to talk. It's the best way to get me is that email address, and feel free to use it. Anything, Norm?
Does Heidi want to say anything?
I just want to thank Tony again for this engaging presentation and thank everybody for attending and wish everyone good holiday season. Thank you very much.
Well, thank you, Hani, and thank you for your leadership at the center. Tony, a comment and a question. In terms of environmental locomotives, I know you're more focused on freight, but you might want to pay a little attention to Metra. We are looking both at locomotives, and the board is authorized to study both of hydrogen as well as battery. And more recently, the board has authorized staff to look at train sets. These are like the diesel multiple unit sets that are in international countries. We're looking at them for two reasons: environmental reasons. It would be some sort of alternate fuel, but also to run shorter, faster, lighter trains in the off-peak area of venues. So you might want to just pay a little attention to that, because we are moving the environmental needle on the commuter rail side.
Glad to hear it.
The question I would ask is, and this may be a little bit out of your general purview, but do you have any sense as to when you think we're going to start to see some really strong improvement in the supply chain situation? It seems like just about everybody's out of balance at this point, including receivers and shippers. And we hear things about labor shortages in China and just about everything else. Do you see this continuing as far as 2023, or do you think it's going to be substantially resolving itself in 2022?
So I don't think it's going to be completely resolved in 2022, but I hope that after the Chinese New Year, that we will see significant improvement. It will drop off the front pages by then. Ship number counts will drop, but it's going to take a while. And this supply chain is multiple supply chains. The auto industry doesn't think they will see their chip shortage resolved before the end of the year. So, and I've heard a really good presentation from Kansas City Southern that talked about how the auto shutdowns put their entire system out of balance. That they were used to moving trains, and so that affected their intermodal operating performance and their et cetera. So these things are so interconnected that one industry, and that's a very big industry, global automobiles, if they're not resolved over the course of the year, then the issue itself can't be resolved. But I think it will move off the front page, incrementally between now and the end of Chinese New Year, which is, I believe, the early February. And when everybody sees that we have enough presents under the tree, that will be one of the issues. When we get the cream cheese back in the delis here in New York, that'll be another. But so I don't have a great sense. It is a little beyond me, but I will tell you that at Rail Trends, the railroads there and the shippers there, the consensus was we're past the worst. Another Churchill quote, this may not be the beginning of the end, but it's the end of the beginning. And so that's what, where I think we are. The caveat always was, barring another unusual event. Right after they said this, you had mudslides in Vancouver, right? That were the second major weather event that disrupted train traffic in the Pacific Northwest. And then we have Omicron, which I've been falsely calling Omicron, which tells you how little I know the Greek alphabet. But Omicron, now we may be getting beyond that too, but it just shows you that we are, I think, slowly recovering, but we're in a fragile state. We began to see, we should have learned more from the problems of the tsunami in Japan, when the auto production was so severely damaged because certain paint types were made over in that part of Japan and couldn't make it over. So, that should have been our warning, that we are stretched our capability it's too fragile. On the other hand, a slight delay in paint is very different from not having enough chips. One of the things I heard at Rail Trends also was that there, I believe, was on the Union Pacific, but I'm not sure. There was a derailment. So Railroad X had a derailment. An auto car slipped off and went to a side. Nobody was hurt, but the auto manufacturer helicoptered in people to harvest the cars that were damaged, rather than fix them, but take the chips out and move those chips from one rail car. So what is it, 30 vehicles, but 30 chips were so necessary that they sent a helicopter to the site. That's that's very fragile supply chain.
Yeah, I would have to agree with you on that. Well, Tony, again, thank you very much for participating again. We look forward to seeing you in person in 2022. As far as Sandhouse is concerned, we're going to continue to have overviews of various segments of the railroad industry. Next month, we're pleased that Bill Von Tuno, the editor-in-chief of Railway Age, is going to again address us. and he's going to give us his perspectives of the overview of what's happening in the railroad industry, not so much from the financial side as we did today, but more from I think the operating and maybe even the marketing side a little bit. With that, happy holidays to all of you. We wish you all a very prosperous 2022. We wish that the COVID situation would be more or less behind us and we can have some sense of normality. And with that, thank you very much for coming, and we look forward to seeing you next year.
Happy holidays, everybody.
Happy holidays.
Thank you, everybody.